Hey, I'd like to introduce someone whose voice you've heard on the show before, and that is Chad. And we have a fantastic little YouTube raffle for you. Chad, what's it all about?
Yes, we have an exciting opportunity coming up for you to be able to win a free ticket to meet the Masters coming up in March, or a $500 travel allowance. Here's what you need to do to be able to win one of those things. We will be selecting a winner on March 4th when the contest ends. And all you have to do is go to the YouTube channel, which is youtube.com/Jason Hartman Real Estate. Subscribe if you haven't already. Then pick any video to watch. There's a variety of categories, everything about real estate investing, from finding the right markets, analyzing real estate deals, the economics of real estate investing, property management, financing. There's a whole wide range of videos that you can choose from, and choose one that you think would be interesting to you, watch it, and then go to the comments section and comment just a quick one-sentence comment on something that you learned from that video. And make sure to include the hashtag JHLive in the comment, and that will enter you into this raffle.
Okay, so that's real easy. You just go to youtube.com/Jason Hartman Real Estate, subscribe to the channel, and then watch any video you like, and make a comment below the video of one thing you learned, include the hashtag JHLive, and that will enter you in the raffle to win a free ticket to meet the Masters or a $500 travel allowance. This ends on March 4th, so be sure to get it done before March 4th. We look forward to seeing you at Meet the Masters. Thanks for joining us, Chad.
Thanks.
This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
Hey, it's my pleasure to welcome a returning guest back to the show, and that is none other than Tom Wheelwright. He will be speaking at our upcoming Meet the Masters of Income Property event, and we're looking forward to having him. He spoke a couple of years ago at one of our Venture Alliance Mastermind events to a small group. Just really enjoyed his talk. He, of course, is the author of Tax-Free Wealth, as part of the Rich Dad Advisors series with Robert Kiyosaki. It's good to have him back. Tom, welcome. How are you?
Doing great, Jason. Always good to be with you.
Yep, good to have you. And I saw you in Dallas. We shared the stage actually a few weeks ago at Ryan Moran's event. He's a good friend of mine, and that's capitalism.com. And got to talking, and, I really enjoyed your talk, as I always do. Let's talk about a few things today. Bonus depreciation, maybe touch on opportunity zones just a little bit, pass through deductions, and what to do. I think this is going to be a hot one, by the way. What to do if you can't become a real estate professional. We've done a lot of shows on how to become a real estate professional, but what if you just can't qualify? All right. How's that sound?
Sounds great. I'm pretty passionate about that last one because I can't qualify. So I've done a lot of figuring out on how to deal with that because I can't qualify personally.
Yeah. Good deal. Okay. Well, that's a good topic. You want to start with that one, actually?
Yeah, sure.
Okay, let's go for it.
The interesting thing about this whole real estate professional passive loss issue is that people get hung up on passive losses, and they go, well, look, a passive loss is not deductible unless I'm a real estate professional. And that's just patently wrong. Okay. That is incorrect. A passive loss, all it means is that you can only deduct it against passive income. All right. So you're thinking, okay, and rental real estate, unless you're a real estate professional, creates passive losses. I mean, if you're going to leverage, especially with bonus depreciation, you're going to end up with a loss, and it's going to be a passive loss if you can't be a real estate professional, if you can't meet those rules. So then the question is, okay, so how do I take advantage of that loss currently? Now, obviously, eventually you're going to get that loss because once you sell the property in a taxable transaction, you get to use all those losses. So it's not like you're losing that benefit. The question is, so here's the question. We'll talk about this more in Meet the Masters. The question is, okay, so if I can't turn the passive loss into a ordinary loss by being a real estate professional, the question is, how can I turn some of my income into passive income?
Right. So
that's
then you can get the offset.
Most people miss, and that's what. And we'll talk about that. We don't have time today, but we'll talk about that at Meet the Masters. Is how do I turn my other income into passive income? So all I have to do, I don't have to be a real estate professional. I just have to get my other income to be passive income. If I can do that, then I can still use the loss.
Right. Okay. So the loss, the tax loss, I should say, and I just want to preface this whole discussion with, of course, income property is the most tax favored asset class in America. We just love it. Real estate professional has always been kind of considered the holy grail of income property tax benefits. So that's why we're talking about it. We've done many podcasts on that topic over the years. And it's interesting that you yourself cannot qualify as a real estate professional. And that all kind of depends on, how much time you spend, where your income comes from, and so forth. So what you're saying, Tom, and this is just a beautiful philosophy on it, is look, maybe you really can't qualify. Okay, you can't become a real estate professional unless you retire, right? Or something like that. Or you got a non-working spouse, only one of you needs to, and that's a cool deal. But if you can shift some of your income from the active income column or the active income bucket to the passive income column, then you can offset these passive depreciation losses. And depreciation is the best tax benefit of all because it's a non-cash write-off. It's like a phantom write-off. So we love it as real estate investors. Give us a little hint about that. I know it's complicated and, it's going to be great when you're on stage and you have a whiteboard and, PowerPoint slides and all the tools to demonstrate, but give us a little hint.
Most people who invest in real estate, they're not W-2 employees. So first of all, husband and wife, W-2, full-time, and you have nothing else going on other than real estate, you're going to have a tough time creating passive income because W-2 wages can never be passive. So that's a challenge, okay? It's not impossible, okay? There actually are some things you could do, but it's really challenging. But most people that I find, and our clients are literally, I did my weekly webinar the other night and did a little survey, and 95% of the people on the call, and we had a lot of people on the call, were real estate investors. So we deal with a lot of real estate investors. That is our specialty. So the thing is, though, is that most of these people also own a business. Okay. And it's when you own a business that you have to think, okay, now I'm always going to be active in that business, but who do I have around me that might not be active in that business? For example, do I have children? Do I have parents? Do I have other people that maybe could have an ownership interest in the business in some way that I still control? And yet they're never going to be involved in the business. I'll give you a really good example. Let's say that you've got an elderly parent that you're supporting. Why not have them own some of your business and some of your real estate?
Yeah, right.
And now they're passive. So their ownership is passive. So sometimes it's just who owns the business. One of the things that we forget is that we've got all these, one of the big assets, I think one of the most underutilized assets that people have is other people's tax brackets.
Okay. That's good. Okay. Other people, OPT, other people's tax brackets.
OPTB, there you go. Yeah. Other people's tax brackets. Like your children have tax brackets, your parents have tax brackets. You might have another family member or somebody else that you're supporting. They have tax brackets. And, why not take advantage of the people that you're going to be you want around you anyway, and that if you don't mind them having some involvement in your finances that you can control. By the way, I can show you how you can control it. So you can still control it completely. In fact, you can make sure they never get any money if you want to do it that way. It's really just an ownership function. So it takes some planning. Don't get me wrong. It takes some planning. There's some I's to dot and some T's to cross, and not everybody will want to do this. But I'll tell you, this is how I do it. So this is what I do. My kids are big real estate owners because of this.
Good stuff. Well, I can't wait to see you kind of demonstrate that on stage at our event. So touch on opportunity zones a little bit. I've sort of said I think they're kind of overrated and overhyped a little bit, especially the funds, because a fund is the same, commandment number 3 problem, thou shalt maintain control, and you're relinquishing control. But you can do it directly. There are some perks and clarifications, definitely. It's not completely without benefit, of course. I mean, hey, it's called an opportunity zone. Do you want to touch on that for a moment?
Yeah, just a couple of things. First of all, the 2 big benefits are if you invest in an opportunity zone directly and you hold that investment for over 10 years, then you could end up with no tax when you sell it. And that's actually a bigger deal than people think, because you go, well, I could always do a 1031. Yes, but when you do a 1031, you don't get new depreciation. So let's say I bought $1 million property and it rose in value to $3 million. Okay. Yes, I could then roll that into a $3 million, or even probably more at that point, because you got equity, you can get more debt. But I could roll that into a new property, but that $2 million of gain, I'm not going to get depreciation on that. Okay, when I roll that into the new property. In an opportunity zone, you'd be able to sell the property for $3 million, take the whole $3 million, and you've got whole new depreciation on that $2 million of gain. So there is actually some tax benefit beyond a 1031 exchange, even if you're staying in real estate. The other big one I think that people don't really think about a lot is that you can roll over any capital gain into an opportunity zone. So that means that you could have had a big stock sale. Your house may be beyond the $500,000, $250,000 exclusion limit. You could have capital gain from your house. You could have capital gain from your business. You could even have capital gain from real estate that maybe you don't want to roll over all of the proceeds into a new property, but you only want to roll over the gain. In an opportunity zone, you only have to roll over the gain. So if you sell stock for $1 million and you have $300,000 of gain, you can roll over $300,000 of gain. Now, you can't roll over stock gain any other way. So you can't roll over business gain. So this is a way to roll over gain, and it is a rollover. You will be taxed on it eventually. It's just a deferral. Right. But you could roll over capital gain from things other than real estate, which I think is really where a lot of people have been investing in the stock market, and they're thinking, well, the stock market's not going to stay up here forever and ever, and they're taking their gains. Then, okay, maybe an opportunity zone makes sense. The other thing you and I were talking about is that there actually are some nice places to invest.
Yeah, they're not all these blighted areas. There's a lot of bad ones, but they're not all bad.
There are a lot of bad ones, but there are, it's like Amazon, their new place in Long Island is at least partially in an opportunity zone.
Well, now the real question is, are they going to actually end up there? Because now there's a big war going on about that.
That is a question. The the congressional delegates from New York seem to be against having business and new jobs. So that's a rather interesting.
New York and California are not known to be business friendly by any stretch.
It's really interesting, really, really interesting. Anyway, so, if you're careful about where you invest, now remember, you actually have to develop the property. This isn't like going and buy a building.
I'm so glad you said that, because you got to take a pretty active role here and increase the basis. You got to basically double it, right?
Right. You have to double the basis, not of the entire property, just of the improvements. Mm-hmm. So the land, you don't have to double the basis of the land. You just have to. So basis is basically what you paid for it. Mm-hmm. So basically, if you paid, I don't know, $1 million for this property and $500,000 is the land and $500,000 is the building, then you have to add $500,000 of improvements for the, double the base. The building spaces is 500,000. You need to double that to $1 million. So you either need to do a knockdown, okay, and put up something new, or you need to really go in and do a complete rehab refurbish.
Yeah, right. So you got to really be like a pretty active investor who's ready to deal with. You have to
be a developer.
Yeah,
you really have to be a developer.
Yeah, right. Okay, yeah. Good to know. Okay, talk a little bit, Tom, about the pass-through loss issue, or did you really kind of cover that? I mean, maybe
no, this is tangentially. So this is something that nobody in real estate is talking about, and there's reasons for it. That people aren't talking about. So we all know about the corporate tax rate reduction, went from 35% to 21%. What some of us have heard, some people have heard, not a lot of people actually, is that business owners, they get a deduction equal to 20% of the net profit from their business. Okay, that's called the pass-through deduction. It's actually called the qualified business income deduction. what most real estate investors don't know is that this applies to them. Okay, this 20% deduction. Now, you have to have net income from the property, but there are a lot of real estate investors. They're like 6-7 years into their property. They've depreciated all the contents of their property. They took big depreciation in the early years. And now they've reduced their leverage because they're concerned about the market, or they've paid down their loan. So now they actually have positive net income from their real estate. If you have positive net income from your real estate, you may qualify for 20% of that being a deduction. The rules are they're detailed, okay? And you kind of have to walk through them pretty carefully to make sure that, you get everything that you're going to get and maximize that. But I think there are a lot of people that show positive net taxable income on their real estate, and they don't know that there's a potential 20% deduction out there.
Yeah. Okay. Good to know. Good to know. I'm sure you're going to get a ton of questions about this at Meet the Masters coming up, but everybody always wants to talk about the real estate professional stuff a little more. And, like you said, what to do if you can't become a real estate professional. Anything you want to say about what if you can become one? Is there anything more on that? Is there anything new on that that's worth talking about?
Well, if you can be a real estate professional, first of all, documentation is going to be key for you, because one thing I can promise is that if you claim that you're a real estate professional and you get audited, they will disallow it. They will disallow it. You will have to prove, okay, remember, this is guilty until proven innocent. You will have to prove that you are a real estate professional. And the courts have been holding pretty consistently that you need really good documentation to prove that not only do you have over 750 hours and more than your other businesses, which is the general rule, but that those 750 hours are really qualified real estate time and not only investor time. So there's a difference between being actively involved in your real estate and being a passive investor. And so you do have to protect yourself in the case of an audit, because I can just guarantee you, I've never seen a taxpayer be audited that claimed real estate professional that was not challenged on that. So I think that's actually a big one. Of course, the other one is the big opportunity. If you are a real estate professional, now bonus depreciation just becomes huge for you, because, I'll give you an example. I'm just working with a client, brand new client, and very first meeting, I'm talking to them, and it turns out that I think they can qualify for real estate professional. And because they qualify for real estate professional and because of their investments during 2018, I think they're going to eliminate a $400,000 to $500,000 tax liability. Eliminate it.
That's amazing.
So we're talking about really big numbers. When you add bonus depreciation, talk about an amazing tax shelter. So consider this, Jason. I remember when I was at your group a few years ago, talked about investing through an IRA. Mm-hmm. So consider this, that there are people, if they qualify as real estate professionals especially, that if they have money in an IRA, that pulling it out and investing in real estate will produce a net tax benefit to them, even after considering the income tax and the penalty on the IRA. That's how big bonus depreciation is. You can actually generate a net. You
positive,
actually be better off tax-wise pulling it out of the IRA than leaving it in the IRA. We never had that before.
Yeah, well, that's an interesting thing that you say that, because I agree with you, and I've read this. I've never talked to you about it, but I've read it in your work. I think these qualified plans are actually a bit overrated, okay? And I know Garrett Sutton has kind of parroted your work on that too, and, shared it in some of his writings and speaking. And sometimes taking an IRA penalty is even worth it just to do a regular investment. Now, I wouldn't do that today because the market is getting, pretty frothy, especially, and it's definitely softening in the, high-end cyclical markets. But, when we were just coming out of the Great Recession and everything was so cheap, we had some stories of clients who did that. It's like, okay, I'll pay the tax and take it, 10% penalty in addition to the tax. And if I can buy relatively new houses for $35 a square foot in these great markets, heck, I don't care, right?
But with bonus depreciation, you actually end up not paying any tax or penalty. You actually end up with a tax refund by doing this.
Yeah.
So it's like, what do you mean? I don't have to pay tax? No, you don't have to pay tax on that IRA withdrawal. No tax. And the net tax benefit can be more than the penalty. So you can actually end up putting money in this is so bizarre.
Yeah.
You can actually end up putting money in your pocket by pulling the money out of your IRA and investing that money into a real estate project. Now, obviously, real estate professional, you've got to be able to use that loss in that same year. And you make sure you match up the years properly. I've run the numbers 100 times, and it's just like, are you kidding me?
That's amazing. Yeah.
That's just amazing. And, the U.S. is the only, I travel a lot with Kiyosaki, and the U.S. is one of the very few countries that allow depreciation on used property at all. But now we allow bonus depreciation on used property. So it's like, this is like, if you're not taking advantage of this, you're just missing an incredible opportunity to reduce or eliminate your taxes.
Yeah, that's definitely true. And it's pretty darn fascinating. When you talk about the qualified plans in general, can you just share a little bit about, what you wrote about that in your book? Because I think that's pretty topical since we just mentioned it. Because, one thing people don't realize, look, if you don't have a Roth, and I'm not a big Roth fan, honestly, because I'm just too paranoid that they'll change the law and, the government's got so much debt, they'll just start looking for low-hanging fruit to tax, and they might just change the rules, right? So I didn't do a Roth myself. And, you're going to pay tax on that money eventually, at either 59.5 or 70, right?
Right.
So it's not like that money is tax-free. It gets to accumulate tax-free, yeah, but it's not tax-free. You're going to have to pay. You either paid it already and did a Roth conversion, or you're going to pay the tax later. And the funny, kind of ridiculous assumption is that you will be poorer in retirement. I want to be richer in retirement, not poorer.
Well, that's the only way it works, is that you're going to be in a lower tax bracket when you retire than you are when you're working. And the challenge with that, of course, is that when you're working, you normally have a lot of deductions. You have business deductions, you have children, you have a home mortgage, you have all sorts of deductions that when you retire, you're not thinking that you're going to have a lot of those deductions. I had a client that he put heavy into qualified plans, and he became a client the year he retired. This was one of my very earliest clients. And he started screaming at me. He said, I've never paid so much tax since I came to you. And I said, hold on. You're paying all this tax because it's all coming out of your profit sharing plan. You have no more deductions. This has nothing to do with me, pal. And we had this big argument over it because he's going, I just can't believe how much tax I'm paying. I've never paid this much tax. Well, he owned a business in real estate for years and years and years. He retires and all he does is have money coming out of qualified plan, which is ordinary income. So you're right that, I think if you want to be poor, sure.
Yeah, right.
Do it. Let me tell you one other challenge with a Roth IRA. I actually have two challenges with Roth IRAs when it comes to investing. And one is that it's really hard to leverage. Okay. If you're looking at any kind of serious leverage, certainly more than 50% loan to value, it's really hard to do that in a Roth IRA because you cannot personally guarantee that loan. So that's a really tough one to do. The other issue is let's say that you invest in something and it goes south. Okay. So you didn't get a deduction when you put the money into a Roth, right? But let's say it goes south and now it's worthless. Guess what? No deduction.
Wow. Yeah.
So you didn't get a deduction going in, and now you don't get a deduction for the worthlessness of the investment.
Boy, that's a bad deal.
I've seen people invest in hard money loans. I've seen people invest in other projects, and they lost their investment. Well, it's bad enough to lose your investment, but to lose your investment and not get a tax benefit is like salt in the wound, right?
Yeah, it really is. That's just ridiculous. Yeah. I think these plans, when they started in, I guess, the early 70s, I believe, they were basically like this old idea, and it was promoted by Wall Street. Look, you'll be in a lower tax bracket when you retire. I mean, first of all, do you think the tax brackets will actually be lower when you retire, first of all? That's the first thing, because the government is starving for money. And number two, who wants to be poorer when they retire? Right? The whole idea is to be richer. So
no, and you said something earlier in the show, Jason, that is one of my hot buttons. And that is, when you talk about a qualified plan, what you want to do is just write down next to it, government controlled.
Good words, yeah.
So, you talked about, I think it was your third rule, right, is you want to be in control.
Right.
Okay, well, that's the biggest issue with any kind of qualified plan, because the government tells you how much money you can put in. They tell you what you can do with it. They tell you how you can do with it.
Right.
They tell you when you have to take it out. They tell you how much you can take out. They tell you what tax rate you're going to pay when you take it out. There's so much control from the government. I'm just going, my experience with most real estate investors who are really at their core entrepreneurs, they want to be in control of their life. And you want to do something that's completely opposite controlling your life. Yeah. Use a qualified plan.
Yeah, no, exactly. I agree. I just think they're overrated. Good stuff. Tom, give out your website. You'll be speaking at Meet the Masters. We're looking forward to having you there. But what's your website?
I'm looking forward to website is wealthability.com. Our goal is to help you increase your ability to create wealth. So I love what you're doing, Jason, because that's really what you're doing is, this is all part of our mission. So wealthability.com, and, anything we can do to help, we're happy to.
Good stuff. Tom Wheelwright, thanks for joining us.
Thanks for having me.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.